Kia ora, and welcome to the CoreLogic Property Market Update for Whiringa Anuku 2022. The housing market in Aotearoa, New Zealand continues to stutter along, with sales volumes remaining low and values continuing to fall. Sales nationwide are 27% down on the long-term average for this time of the year, illustrating demand remains constrained due to credit unavailability and higher mortgage rates. For the main centres in the top half of Te Ika Maui, sales volumes have come back even further, 38% lower than seasonal norms in Tamaki Makaurau, and roughly 30% in both Kirikiriroa and Tauranga. Meanwhile, volumes are also 15% down in Ōtautahi, after they'd previously held up a bit better than the rest of the country. Reduced sales transactions likely means further weakness to come for values too. The CoreLogic House Price Index for September did show a slight reduction in the rate of fall, with the nationwide index dropping by 1.5%, compared to 1.8% in August. But the prevailing story has to be the persistent negative change, rather than the reduced rate of decline. The downswing is broad-based across the country, with very few cities avoiding the recent falls in value. The Wellington region is experiencing the largest rate of decline, which exceed even those seen in the aftermath of the global financial crisis in 2008. Ōtepoti too, down 5.4% over the last 3 months, is experiencing a sharper correction than most. While strong post-pandemic growth is touted as a possible factor for those areas seeing larger falls now, value increases were so widespread it appears to be more a reflection of growth prior to the pandemic influencing value falls now. Indeed, housing affordability is at the heart of this, with increasing interest rates having the greatest effect where affordability is stretched the most. This is particularly the case for investors considering buying an existing property, now without the ability to deduct those interest costs from their tax return. The financials of purchasing an asset with no or limited short-term capital growth, increased costs and relatively low yield are clearly playing on the minds of property investors requiring a mortgage. Just 20% of sales went to this group in September, an all-time low proportion. There also seems to be caution from investors around whether or not a potential national-led government after the next election would actually repeal the interest deductibility changes. In contrast, first-home buyers appear to once again be willing to adjust their expectations to get into the market, driven by more than pure dollars. Looking long-term, and with the benefits from falling prices outweighing interest rate increases, their share of purchases held firm in September at 24%, continuing the upward trend since March and the highest proportion since January. Interest rates will continue to be a consideration for all buyers though. The Reserve Bank isn't shying away from its inflation battle. It lifted the OCR a further 50 basis points to 3.5% this month, with more increases to come. Inflation is proving to be a stubborn beast to impact, and the Reserve Bank has been very clear about continuing to lift the OCR to get inflation under control, even if it means they need to reduce the OCR later. It must be said though, that so far mortgage holders have been able to manage the increased mortgage repayments. A large proportion of the refinancing wave has passed through and appears to have done so without too much trouble, with reported mortgage arrears remaining low as people stay employed and incomes continue to increase. For property investors, the environment remains a challenging one however, navigating reduced rental demand due to net migration outflows and rental price growth falling back to more average levels. It should be noted that investors are not mass exiting the market though, with established investors in a better position financially to hold their property, even with increased regulation. The new build market will continue to be an attractive one for investors too, and there are signs that the construction industry is proving more resilient than 15 years ago when it experienced a significant downturn, and one that took a long time to recover from. This bodes well for the future, though continued pressure on costs, which are up 9.6% in the last year, according to the Goodall Construction Cost Index, will likely remain a challenge into 2023. On the plus side, at least the shortages of plasterboard seem to have been resolved. There are still a few more key releases to come before the year is out, so make sure you keep across all our latest updates by following CoreLogic NZ on LinkedIn, Twitter, Facebook or Instagram, and subscribing to the New Zealand Property Market Podcast released every Monday afternoon. Mā te wā.